School of Management Studies IGNOU presents an audiobook on the course MMPC 004 Accounting for Managers for MBA program. Presenting Block 1 Accounting and Overview, Unit 1 Introduction to Accounting, Part 2.
Emerging role of accounting. The history of accounting indicates the evolutionary pattern which reflects changing socio-economic conditions and the enlarged purposes to which accounting is applied. In the present context, 4 phases in the evolution of accounting can be distinguished. Number 1. Stewardship accounting. In earlier times in history, wealthy people employed stewards to manage their property. These stewards rendered an account of their stewardship to their owners periodically. This notion lies at the root of financial reporting even today, which essentially involves the orderly recording of business transactions, commonly known as bookkeeping. Indeed, the accounting concepts and procedures in use today for systematic recording of business transactions have their origin in the practices employed by merchants in Italy during the 15th century. The Italian method, which specifically began to be known as double-entry bookkeeping, was adopted by other European countries during the 19th century. Stewardship accounting, in a sense, is associated with the need of business owners to keep records of their transactions, the property and tools they owned, debts they owed, and the debts others owed to them. Number 2. Financial accounting. Financial accounting dates from the development of large-scale businesses and the advent of joint stock company, that is, a form of business which enables the public to participate in providing capital in return for shares in the assets and the profits of the company. This form of business organization permits a limit to the liability of their members to the nominal value of their shares. This means that the liability of a shareholder for the financial debts of the company is limited to the amount he had agreed to pay on the shares he bought. He is not liable to make any further contribution in the event of the company's failure or liquidation. As a matter of fact, the law governing the operations or functioning of a company in any country, for instance, the Companies Act in India, gives a legal form to the doctrine of stewardship, which requires that information be disclosed to the shareholders in the form of annual income statement and balance sheet. Briefly speaking, the income statement is a statement of profit and loss made during the year of the report, and the balance sheet indicates the assets held by the firm and the monetary claims against the firm. The general unwillingness of the company directors to disclose more than the minimum information required by law and the growing public awareness have forced the governments in various countries of the world to extend the disclosure of information requirements. The importance attached to financial accounting statements can be traced to the need of the society to mobilize the savings and channel them into profitable investments. Investors, whether they are large or small, must be provided with reliable and sufficient information in order to be able to make efficient investment decisions. This is the most significant social purpose of financial accounting. Number 3. Cost accounting. The Industrial Revolution in England presented a challenge to the development of accounting as a tool of industrial management. Costing techniques were developed as guides to management actions. The increasing awareness on the part of entrepreneurs and industrial managers for using scientific principles of management in the wake of scientific management movement led to the development of cost accounting. Cost accounting is concerned with the application of costing principles, methods, and techniques for ascertaining the cost with a view to controlling them and assessing the profitability and efficiency of the enterprise. Number 4. Management accounting. The advent of management accounting was the next logical step in the developmental process. The practice of using accounting information as a direct aid to management is a phenomenon of the 20th century, particularly the last 30 to 40 years. The genesis of modern management, with its emphasis on detailed information for decision making, provide a tremendous impetus to the development of management accounting. Management accounting is concerned with the preparation and presentation of accounting and controlling information in a form which assists management in the formulation of policies and in decision making on various matters connected with routine or non-routine operations of business enterprise. It is through the techniques of management accounting that the managers are supplied with information which they need for achieving objectives for which they are accountable. Management accounting has thus shifted the focus of accounting from recording and analyzing financial transactions to using information for decisions affecting the future. In this sense, management accounting has a vital role to play in extending the horizons of modern business. While the reports emanating from financial accounting are subject to the conceptual framework of accounting, internal reports, routine or non-routine, are free from such constraints. Next comes social responsibility accounting. Social responsibility accounting is a new phase in the development of accounting and owes its birth to increasing social awareness, which has been particularly noticeable over the last 2 decades or so. Social responsibility accounting widens the scope of accounting by considering the social effects of business decisions in addition to the economic effects. Several social scientists, statesmen, and social workers all over the world have been drawing the attention of their governments and the people in their countries to the dangers posed to environment and ecology by the unbridled industrial growth. The role of business in society is increasingly coming under greater scrutiny. The management is being held responsible not only for efficient conduct of business as expressed in profitability, but also for what it contributes to social well-being and progress. There is a growing feeling that the concepts of growth and profit as measured in traditional balance sheets and income statements are too narrow to reflect the social responsibility aspects of a business. Human resource accounting. Way back in 1964, the first attempt to include figures on human capital in the balance sheet was made by Hermansen, which later came to be known as human resource accounting. However, there had been a great socio-economic shift in the 1990s with the emergence of knowledge economy, a distinctive shift towards recognition of human and intellectual capital in contrast to physical capital. Human resource accounting is a branch of accounting which seeks to report and emphasize the importance of human resources, that is, knowledgeable, trained, loyal, and committed employees in a company's earning process and total assets. It is considered with the process of identifying and measuring data about human resources and communicating this information to interested parties. In simple words, it involves accounting for investment in people and replacement cost as well as accounting for the economic values of people to an organization. Generally, the methods used for valuing and accounting of human resources are either based on cost or on economic value of human resources. However, providing adequate and valid information on human assets or capital which are outside the concept of ownership in figures is very difficult. Nevertheless, HRA is a managerial tool providing valuable information to the top management to take decisions regarding adequacy of human resources and thus encouraging managers to consider investment in manpower in a more positive way. Inflation accounting. Inflation accounting is concerned with the adjustment in the value of assets, that is current and fixed, and of profit in the light of changes in the price level. In a way, it is concerned with the overcoming of limitations that arise in financial statements on account of the cost assumption, that is, recording of the assets at their historical or original cost, and the assumption of stable monetary unit. It thus aims at correcting the distortions in the reported results caused by price level changes. Generally, rising prices during inflation have the distorting influence of overstating the profit. Various approaches have been suggested to deal with this problem. Accounting personnel. There is hardly any organization which does not have an accountant. His role is all-pervasive and he is involved in a wide range of activities, particularly in a large and complex organization. The exact duties of an accountant might differ in different organizations. However, a broad spectrum of responsibilities can be identified. The accountants can be broadly divided into two categories: those who are in the public practice and those who are in private employment. The accountants in public practice offer their services for conducting financial and cost audit. As such, they are known as auditors. The auditor examines the books of account and reports on the balance sheet and profit and loss account of the company as to whether they give a true and fair view of the state of affairs of the company and its profit, respectively. The auditor in a company is appointed by the shareholders to whom he reports. Public accountants are generally members of professional bodies like the Institute of Chartered Accountants of India or the Institute of Cost and Works Accountant of India. In addition to conducting financial or cost audit in accordance with the requirement of the Companies Act, as the case may be, they may also provide consultancy services for designing or improving accounting and management control systems. Accountants in employment may be in various business or non-business organizations to perform a variety of accounting and management control functions. Accountants at higher levels generally belong to professional accounting bodies, but those who are at lower levels need not be so. Accounting chiefs in different organizations, depending upon their nature of work, are variously designated as finance officers or internal auditors or chief account officers, etc. The term controller as the head of the accounting and finance function is not very popular in India, but of late it has been catching up. Several large organizations, both in the public and private sectors, have now controllers. Let us have an idea of who these people are and what they do. Internal auditor. Internal auditor is an employee of the organization in contrast to an external auditor who is paid a fee for his services. The internal auditor is responsible for performing monitoring activities and other services, including designing and operating the system of internal control, auditing the data reported to the directors of the company, and assisting external auditors. The head of the internal audit function reports directly either to the chief executive or to the audit committee of the board of directors. Internal audit includes continuous verification of entries appearing in the books of account with the original vouchers and proper accounting of assets. Further, it attempts to ensure that the policies and procedures regarding financial matters are being complied with. Internal auditing is also concerned with administering the system of internal check so that mistakes, innocent or intentional, are prevented from taking place. We should distinguish an internal auditor from an external auditor. While an internal auditor devotes his entire time and energy to the needs of one company, that is his employer, an external auditor serves many clients. The primary function of the external auditor, as pointed out earlier, is to safeguard the interest of the shareholders, by whom he is appointed, by an independent and impartial appraisal of the financial transactions of the company, so that he could report on the net profit earned by the company and its financial position. His role is that of an objective outsider, expressing expert opinions to the financial condition and operating results of the client's business. Apart from shareholders, other parties such as banks, lending institutions, government agencies, etc. rely on the fairness of such financial reports in making certain decisions about a given company. An auditor is bound by a set of professional regulations which include an examination on technical competence and adherence to a code of ethical conduct. Controller. Controller, the other name for chief accountant, is usually the head of the whole area of accounting, including internal audit. He is overall in charge of all the activities comprising financial accounting, cost accounting, management accounting, tax accounting, etc. He exercises authority both for accounting within the organization and for external reporting. The external reports include reports to government revenue collecting and regulatory bodies such as Company Law Board and Income Tax Department. He may also supervise the company's internal audit and control systems. In addition to processing historical data, he is expected to supply a good deal of accounting information to top management concerning future operations in line with the management's planning and control needs. Besides, he is also expected to supply detailed information to managers in different functional areas like production, marketing, etc., and at different levels of the organization. We may enumerate the functions of the controller as designing and operating the accounting system, preparing financial statements and reports, establishing and maintaining systems and procedures, supervising internal auditing and arranging for external audit, supervising computer applications, overseeing cost control, preparing budgets, making forecast and analytical reports, reporting financial information to top management, and handling tax matters. Treasurer. He is the custodian errand manager of all the cash and near cash resources of the firm. The treasurer handles credit reviews and sets policy for collecting receivables or debtors of the firm to whom the firm has sold goods or services. He also handles relationship with banks and other lending or financial institutions. Finance is the lifeblood of business. Procuring financial resources and their judicious utilization are the two important activities of financial management. Financial management includes three major decisions: investment decision, financing decision, and dividend decision. Investment decision is perhaps the most important decision because it involves allocation of resources. It is concerned with future, which being uncertain involves risk. How the firm is allocating its scarce resources and is planning growth will largely determine its value in the marketplace. Financing decision is concerned with determining the optimum financing mix or capital structure. It examines the various methods by which a firm obtains short-term and long-term finances through various alternative sources. The dividend decision is concerned with questions like how much of the profit is to be retained and how much is to be distributed as dividends. The finance manager has to strike a balance between the current needs of the enterprise for cash and the needs of the shareholders for an adequate return. The financial management of a large company is usually the responsibility of the finance director, who may be in place of or in addition to the controller. Often finance manager and controller are interchangeable terms, and only one of these two positions may be found in a company. The finance manager, when there is a controller also in the organization, is concerned with implementing the financial policy of the board of directors, managing liquidity, preparation of budgets, and administration of budgetary control system, managing profitability, etc. Though financial management is regarded as a separate area, this function is performed in various countries, including India, by the accountant or the financial controller. In several large organizations, however, they have a financial executive besides the chief accountant. Often finance and accounting functions are clubbed together in one person in small organizations.
We were listening to the audiobook by the School of Management Studies IGNOU for MBA program course code MMPC 004 Accounting for Managers. Course Coordinator Professor Kamal Bagrecha, School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Ruchi Sharma. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.